Let's ask Joe Quinlan. He's chief market strategist over at U.S. Trust, a division of Bank of America with $367 billion in assets. Joe, great to have you back with Matt and myself. What is the focal point for the markets in your view? Is it Philly Fed? Is it though, or is it just we got to keep watching what's coming out of Europe at this point?
Carol, you got to watch what's coming out of Europe. I think today Walmart helped the markets, as did Home Depot. So I think there's a benefit of doubt in the United States that the soft patch is getting a little firmer here, and the second half is going to be better. We're still in a slow growth environment, but all eyes are on Europe. And as you were just talking about, Matt, with his guest, Europe, they never cease to disappoint, and they didn't disappoint us today.
Right. Hey, this takes me perfectly to something Warren Buffett said. I want to bring this in. Warren Buffett giving Charlie Rose his take on the Fed's latest move. Listen up, everyone.
The Fed is saying, when they say we're going to keep it rates low until 2013, that they say they're really saying the economy's not going to be very good until then. It's an unusual statement.
Would you disagree with?
I think there's a chance they're wrong. Yeah, I think it may pick up before then.
Joe, do you share Mr. Buffett's enthusiasm, if you will, if you want to call it that it will indeed the economy pick up?
Well, I hope Warren's right, and Ben Bernanke doesn't have to keep interest rates that low. I think it's going to depend on confidence from the CEOs and the consumers. For Washington getting its act together. It's going to depend on the emerging markets being more of a driver of growth, i.e., consumption and not exports. We're well placed to export more, but we need the demand. We need Europe to settle down. So I wouldn't etch that in stone 2013. It could be earlier.
Your take on what we've seen on the corporate earnings environment? Not too bad.
Not too bad at all, Carol. I think it's going to be like 15% year over year. The guidance, pretty good up until the Washington drama. I think there's going to be a lot of caution going into Q3. That's warranted. But I still think there's a good head of steam. We've had nice double-digit year-over-year growth. I think you're going to see that in Q3. We'll have some concerns about 2012 if we don't see these real economic indicators pick up. But that's to be, down the road.
We mentioned Warren Buffett, and Adam, I want to actually bring you in here because we've had a lot of Buffett talk as of late. He's made a lot of comments, whether it's on the AAA status of the United States and so on, and has really attracted attention from Washington also after his comments on taxes, hasn't he?
Well, and this is an election cycle, so all of a sudden Warren Buffett now in full swing of that. You got to listen to what Michelle Bachmann said about Buffett's comments about taxes. All right, listen up.
Perhaps Mr. Buffett would like to give away his entire fortune above $200,000. If that's what you want to do, have at it. Give it to the federal government. But don't ask the rest of us to have our taxes increased.
All right, let the games begin. It's election time. So, Joe, my question to you is, at a time like this, where now all of a sudden you've got people like Buffett getting dragged into the whole Washington mess, does that undermine what actually can happen in the market? And does all that angst underscore what S&P said, and that is that we can't really get anything done in Washington?
It could, Adam. It's Warren's just trying to make light of the fact that we need to rethink the tax code. I think that was the primary message. And if that's going to be ignored by Washington, yeah, that's going to upset Wall Street unequivocally. So, Warren's done us a great service, but I hope we have more of a kind of a more balanced debate about how we go about making the tax code fairer, more equitable, and more efficient.
So. All right. Hey, so Joe, it's funny, we talked about yesterday coming off of the market. It was like, I think Adam actually made the point. It was almost like last week didn't happen despite all those violent swings that we got in the marketplace. Are you anticipating that volatility is going to continue? And if so, how do you position yourself in your portfolio?
Well, first, Carol, I do think the volatility is going to be here because there's a tremendous uncertainty overhanging not only the U.S. economy, but Europe. The numbers out of China, the inflation rates. So there's going to be uncertainty. How do you position yourself? I still like these big multinationals, consumer staples, some in IT, some in industrials, have very good dividend yields, better than U.S. Treasuries. And, even if we get a slow patch, even if we get a global, slowdown here, these companies are still going to grow in an environment where the economic pie globally, it's going to expand by 4.5% over the next 12, 24 months. So
right.
Stay in the large caps.
So, and that's how you like to play the emerging markets. And I want to go there because Adrian Mowat, JP Morgan's top strategist for emerging markets, he actually spoke to Bloomberg's Asia TV this morning on when it might be right to buy in terms of the emerging markets. Listen up, everyone.
We're probably very close to the lows for the year. The reason that I don't emphatically say this is the buying moment is we still have an inflation problem in the big emerging markets.
But again, Joe, your take is not necessarily buy the names in the emerging markets, but buy those multinationals who have incredible exposure to them, correct? Have
the exposure, have the cash flow, have the dividends. The emerging markets wait. I think you're going to be able to buy them cheaper in the fall because haven't fully priced in the inflation and or the slowdown in the Western world, which will hurt the emerging markets. So they'll be cheaper in the fall.
Joe, I got to ask you because we actually came across some of the notes that we did for you earlier this year back in May. And it was funny. We were looking at your target for the S&P at that point. It was like 1425. So that's about a 20% move from here. Where are you in terms of what we might see on the S&P by the end of the year? Are you sticking to 1425 or that's way too aggressive?
We've now factored into our strategy that there's going to be a recession in Europe. And so we pulled back 1350 to 1400 is our target because Europe is very important to a lot of U.S. companies across the industrial spectrum. So we've kind of threw in the towel with Europe, and so that we therefore had to adjust our sights when it comes to the S&P.
You know, you mentioned Europe. Is there something we could get out of Europe? Obviously, the markets are pretty disappointed today in terms of what we did or did not get out of Sarkozy and Merkel. So I'm just curious, is there something that we could get out of Europe in your view that could maybe change your outlook here, maybe make you more optimistic about the U.S. because maybe it would lessen the European impact?
Not necessarily.
Yeah,
I mean,
it doesn't feel that way, does it?
Yeah, I want to see U.S. legislators look very careful at Europe and see the market punishment that's being doled out and say, let's avoid this by getting on with the bipartisan commission and making it work. We have still a window to make it work.
All right. Hey, listen, Joe, we're going to leave it there. We've covered a lot of ground, and we appreciate it. Thank you so much.
Thank you.
Joe Quinlan, everybody, Chief Market Strategist over at U.S. Trust.